in every major crash: 1929, 2008, and now the rising signals for 2026. The warning signs were visible long before disaster hit. Today, those signals aren't just flashing. They're screaming. Tech bubbles are swelling, markets are overheated, and global tensions are tightening. What's coming may not just match past crashes, it may surpass them. Most people believe financial disasters strike suddenly, but history shows the opposite. Crashes build slowly, quietly, through patterns that repeat across decades. As we move toward late 2026, those patterns are aligning in a way we've only seen before: the worst collapses in history. From exploding corporate debt to weakening consumers and a Federal Reserve trapped with no safe choices. Every piece fits the timeline of a perfect storm. In this video, we'll break down why economists, historians, and insiders warn that 2026 to 2027 could be more devastating than 1929 and 2008 combined, and why understanding these signals now is more critical than ever. Beneath the surface of today's booming markets lies a silent pressure building faster than most people realize. Household debt is at historic highs, corporate borrowing is reaching dangerous extremes, and government deficits are ballooning at a pace unseen in modern history. Consumers are running out of savings, relying on credit to survive, and missing payments at levels not seen since the early stages of previous collapses. Housing is overpriced, wages are slowing, and real economic strength is weakening. These are the exact early warning symptoms economists identified before both 1929 and 2008, quiet stress signals that explode when ignored. The financial system isn't stable, stretched thin like glass under heat. And when that glass finally cracks, what it triggers next will shock everyone who isn't watching closely. The Federal Reserve is stuck in a no-win scenario that mirrors the same policy failures before the worst crashes in history. Rates are high enough to hurt growth, yet still not high enough to fully tame inflation. If the Fed cuts too soon, inflation surges back. If they stay high too long, the economy suffocates. This delicate balance is exactly what collapsed in 1929 and broke again in 2007. Today, the Fed is trapped between market pressure and economic reality, able to move without causing damage. Every decision now carries consequences, and every delay makes the situation more unstable. The illusion of control is fading, and insiders know the landing won't be soft. But the real danger appears when this policy trap meets the next terrifying factor, because this time everything is inflated together. Unlike previous collapses, this time nearly every asset class is inflated beyond reason. Stocks are trading at extreme valuations, housing prices are detached from incomes, crypto is fueled by speculation, and even bonds, traditionally safe, show massive distortions. This synchronized bubble is unprecedented. It combines the stock euphoria of 1929 with the housing mania of 2007 and the speculative frenzy of modern markets. When one bubble bursts, it pressures all the others, but when all bubbles burst together, the system can unravel at lightning speed. Investors assume the rise is permanent, but history warns us that the higher the climb, the harder the fall. Everything is rising without real economic strength behind it. And the moment everyday consumers begin to break, this entire inflated structure collapses faster than anyone expects. The American consumer, the engine of global demand, is weakening at the worst possible moment. Real wages aren't keeping up, savings are nearly gone, and credit card interest is crushing millions. Auto loans, mortgages, and student debt are hitting record strain. Delinquency rates are climbing at a pace identical to the months before the 2008 crash. When consumers fall behind, spending drops. When spending drops, businesses lose revenue. And when businesses lose revenue, layoffs explode. This is exactly what happened before 1929 and again before 2008. But now, the pressure is magnified by higher living costs and deeper debt. Consumers are running out of room to breathe, and the breaking point is closing in. Because the moment consumers crack, corporations crumbling, that's where the next chapter gets even darker. Behind the polished headlines and artificial market optimism, corporations are weakening rapidly. Bankruptcies are rising, earnings are shrinking, and businesses are cutting staff not to grow but to survive. Layoffs in tech, retail, transportation, and finance are accelerating, mirroring the early warning stage before the 2008 collapse. Meanwhile, AI-driven automation is replacing jobs faster than companies can adapt, creating long-term instability in the labor market. When companies fire workers, demand falls even more, starting a destructive cycle that markets always underestimate. This is the same corporate unraveling that led to the painful declines of past crashes, but in 2026, the scale is far greater. And if corporate weakness weren't enough, global pressures are forming a chain reaction that makes 2026 uniquely dangerous. The world is more fragile and interconnected than ever before. Wars, trade wars, energy shocks, and supply chain vulnerabilities are growing simultaneously. Key nations are slipping toward recession, and international financial systems are showing cracks. In both 1929 and 2008, global tension amplified the collapse, turning a financial crisis into a worldwide disaster. Today, global instability is far more intense, meaning any major shock spreads instantly. Rising oil prices, unstable currency markets, and geopolitical rivalries are creating a perfect storm around an already fragile global economy. When global tension meets economic weakness, downturns don't just happen, they accelerate. All these forces are converging toward a single moment in time, and that flashpoint appears terrifyingly close. Every crash in history has a spark, a sudden event that unleashes all the hidden pressures at once. In 1929, it was margin debt. In 2008, it was subprime mortgages. In 2026, the spark could be a credit freeze, a liquidity crisis, a housing rollover, a bond market shock, or even a tech sector implosion. The danger is that multiple triggers are lined up at once, and corporate debt maturities, peaking in late 2026, could become the final straw. Liquidity is thinning, markets are reactive, and even a mild shock can cascade into something uncontrollable. Q4 2026 is shaping up to be the most vulnerable period in decades, but the true devastation doesn't happen during the trigger, it happens afterward. In 2027, if the crash ignites in late 2026, the true economic damage arrives in 2027. Markets plunge first, but then comes the deeper pain. Layoffs, frozen credit, bankruptcies, collapsing home prices, and a global recession feeding on itself. Banks tighten lending, investors panic, and economic activity slows dramatically. This cascading failure mirrors the aftermath of both 1929 and 2008, but this time, leverage is higher, safety nets are weaker, and global risk is far more widespread. The result could reshape markets, careers, and wealth for an entire generation. Those who recognize the patterns will survive and thrive. Those who ignore them will face the hardest financial years of their lives. And that is why the final message of this documentary may be the most important warning you hear this decade. In the end, every major financial collapse teaches the same painful lesson. The warnings were always there, but most people refused to see them. History doesn't repeat by accident. It repeats because human behavior never changes. And as we move toward 2026 and 2027, the patterns of 1929 and 2008 aren't just reappearing. They're merging into something even larger. The investors, families, and businesses who survive the next downturn won't be the ones who react the fastest. They'll be the ones who understood the signals before the storm began. That's why staying informed isn't optional anymore. It's essential. If this documentary helped you see the bigger picture, make sure you like this video, subscribe, and join us here on Money Timeline, where where we track every major shift in financial history. The next chapter of the economy is already being written. Don't miss what happens next.